everybody, my name is Liam Doran from accountancyschool.ie, and in this presentation I'm going to look at Section 19 of FRS 102. It's the section that deals with business combinations in Goodwill. And we're told in Section 19 that a business combination arises where there's a bringing together of separate entities or businesses into one reporting entity, usually by way of an acquirer gaining control of one or more businesses. Now what's important here is you must be gaining control of a business. And the definition of control is given as the power to govern the financial and operating policies of an entity so as to obtain benefits from its activities. This is assumed to exist when you own more than half of the share capital in a company. However, you could have a situation that you own less than half of the share capital in a company, but you might have the power to appoint the board of directors. And if you had the power to appoint the board of directors, well then you've got the power to govern the financial and operating policies. In that situation, you still have control. Assuming that you have control, you then must make sure that you've got control of a business. And a business effectively, or in a nutshell, a business is where you've got inputs, you've got processes over those inputs, and you're able to generate outputs. If you have a business and you've taken control of that business, then you're dealing with a business combination under Section 19. Now, the reason why I'm highlighting what a business is because you could be acquiring an entity that doesn't carry on a business. And if you acquire an entity that doesn't carry on a business, you've acquired an entity, and therefore you have a subsidiary that you will need to consolidate. But if there is no business activity, well then there is no business combination. And if there is no business combination, then there is no goodwill. An example of that might be where you buy a company that owns an investment property. And the investment property, let's imagine, is a piece of land. So an entity acquired a piece of land, and that's the only asset that they have. They're holding the land for capital appreciation. If you buy that entity, you're not buying a business. You're taking control of an entity that simply has an asset. And in that situation, there wouldn't be the requirement to calculate goodwill because it wouldn't meet the definition of a business combination under Section 19. Let's assume, however, that we just have acquired control of a business. If you've acquired control of a business, then what you need to do is you need to go and you need to calculate goodwill. And goodwill is calculated by following a series of steps. The first step is you must identify the acquirer. The second step is you must identify the date of the business combination. You then must identify the cost of the business combination. You then must allocate the cost of the business combination to the assets acquired, to the liabilities and the contingent liabilities assumed. You must determine a value for your NCI, and then you must measure and record your goodwill. So there's effectively a series of steps that you need to go down through. And if we look at those briefly, identifying the acquirer invariably is going to be relatively straightforward. The person making the acquisition is the acquirer. But if you're dealing with a complex scenario where it's not very apparent as to who the acquirer is, usually the acquirer is the larger of the two parties that are involved in the business combination. If you've got one acquirer, one party taking control of another party, well then usually the one taking control is the larger company. Secondly, the person who gives up cash or other assets in order to make the payment is invariably going to be the acquirer. Or finally, the person who's able to determine the composition of the management of the new combined entity or the new combined group, who's ever able to control the composition of that management, that's usually the acquirer, because that's the person that's taking control. The next step is you need to identify the date of the business combination, and in a nutshell, the date of the business combination is the date that the acquirer gets control of the business. So as soon as you have the power over the financial and operating policies of the entity so as to obtain benefits from the entity's activities, that there is the date that you got control, and as soon as you get control, that's the date that you've got a business combination. The third thing that we need to identify is the cost of the business combination, and basically this will involve you having to identify the fair value of the assets given up, the fair value of any liabilities assumed, the fair value of any equity instruments that are granted to the previous owners of the business, but you also need to add in any of the direct costs of the acquisition. So things like legal fees and due diligence costs, they'll be included as part of the cost of the business combination. If you do have a piecemeal acquisition, that's going to arise where instead of simply going out and buying the controlling interest in one fell swoop, what you're going to do is you're going to build up your ownership over a number of acquisitions. And that might be where, for example, I'll buy 20% of the entity, and then I'll buy another 20% of the entity, and then I'll buy another 30% of the entity. That's 3 individual acquisitions you've made. But you didn't get control of the business until you bought the third tranche of shares, because that was the one that brought you over your 50% ownership. In that situation, what you need to do is at each individual date of making an acquisition of shares, you need to calculate the fair value of the consideration for that particular tranche. And then the aggregate of the 3 payments is going to be brought in order for you to calculate your business combination cost. You could have a situation that you've got a contingent payment, and a contingent payment is where there will be a variation to the amount that needs to be paid, which is contingent upon uncertain future events. Now, basically what you need to do here is, based on all available information, determine the most likely cost of the business combination. And it's the most likely cost of the business combination that you will include for the purpose of calculating your goodwill. There may be a change to that estimate, and if there is a change to the estimate, you're going to have to adjust your goodwill figure based on the new information that becomes available about the most likely outcome. But effectively what you're doing is you're estimating your goodwill figure at each reporting date up until the day that you know for definite what the final payment is going to be. The next issue that can arise is there might be a deferred payment. And it's a common enough thing that you'll buy a business from somebody and you'll agree with them that you're going to pay them an amount of money, but you're just not going to pay it today. You're going to pay them an amount of money on a future date. And if that arises, or if that occurs, as long as the time value of money is material, well then you need to discount the future sum that you've got to pay back to present value. And it's the present value of the future sum that we include as part of the business combination cost, and ultimately therefore include as part of the goodwill calculation. I'm going to have a quick look at an example here on screen, and if you have a look you can see that we've got an acquisition whereby we're going to make a cash payment of €500,000. We're going to transfer land in part payment, which has a carrying value of 100,000 but a fair value of 150. We're then going to issue some shares in order to make the payment. The number of shares that we're going to issue are 10,000 in total. There is no fair value observable, I should say, for the shares, but the price earnings multiple in the industry is 10, and the earnings per share of the acquirer per the most recent financial statements is 15 cents. A discount rate of 30% is appropriate to reflect the non-marketability of the acquirer's shares. So what we're going to have to do there is to determine the fair value of the equity that was granted. There's a deferred payment of €200,000, which is payable in 3 years. We're told an appropriate discount rate is 6%. There's a contingent payment that's based on future profits of 125,000, but we're told that it's not expected that the profit target will be achieved. Finally then we have direct costs associated with the acquisition incurred by the acquirer of €15,000. So if we run down through these, first couple are relatively straightforward. We're going to make a cash payment of 500,000. Fair value of cash given up is the value of the cash given up. We're then going to transfer land which has a carrying value of 100 but it's got a fair value of 150. So we'll include the fair value of the asset given up. We're then going to grant shares in our entity. Now what we need to do here is we need to determine what the fair value of the shares are. We're told that the industry price earnings multiple is 10, but because we're not a listed company, we wouldn't have a share which is valuable or is as valuable as if we were a listed company. So normally what we'll do is we discount the price earnings multiple for the industry to reflect the non-marketability of our shares. And we're told in the example to assume that a 30% discount would be appropriate. So what we'll do is we'll take 70% of the price earnings multiple, which is 7. You then multiply your price earnings multiple by your earnings per share, and that gives you a theoretical value for each individual share that we've given. The question tells us that we're going to grant them 10,000 shares. So 10,000 shares at a value of €1.05 per share gives me a value of €10,500. Okay, the next thing we have is a deferred payment. And we're told basically that we have an obligation to pay a further €200,000, but we're not going to pay that today, we're going to pay that in 3 years' time. We're told to assume that a 6% would be an appropriate discount rate. And if you look up your factors or your tables to identify what the appropriate factor is at 6% for 3 periods, you'll see that the appropriate discount factor is 0.84. When you multiply your factor by your cash flow, you get your present value. So the present value of that future sum is 167,924. The present value of the future payment is the fair value of the deferred payment. Okay, the next element that we have here is a contingent payment, and we're told that there is a contingent payment that's based on future expected profits, but there are profit targets that we're specifically told we don't feel we'll achieve. And what we need to do at the outset is we need to determine the best estimate as to what we feel the contingent payment will be. And in this particular example, the best estimate is the contingent payment is nil. Finally then, we have to include the direct costs incurred, which are 15,000. And when you add all of your individual elements together, you've got your cash of 500,000, you've got your land of 150, you've got the value of the shares issued of 10,500, you've got the present value of the deferred payment of 167,924, the contingent payment has a fair value today of 0, the costs incurred in order to effect the business combination are 15,000, the total cost of the business combination therefore is 843,424, and it's that 843,424 that we will include in the goodwill calculation. Now, just to highlight here for a moment, because it is important, we're dealing with a deferred payment, and because we have a deferred payment and the amount of the deferred payment we said was 200,000, we've discounted that back to present value, and we calculated the present value of that sum at 167,924. Now effectively what this means is, in today's money we have an obligation to somebody worth 167,924, and to settle that obligation we're going to pay them 200,000 in 3 years. And when you owe somebody money and you're going to pay them a larger amount on a future date than you'd have to pay them in today's money, well then the difference is interest that's being charged. So what we need to do is we need to what they call, or what they refer to as, unwind the discount rate. We need to calculate the appropriate interest charge that will appear in your profit and loss account each year for the next 3 years. And to do that you need to set up a table like the one we have here. You take the opening obligation, which is the 167,924, that there is the present value today of the sum that we have to pay in future. We then increase it at 6% to calculate the interest for the first year, and that brings the liability up to 177,999. At the beginning of the second year, the liability is 177,999. We charge another 6% interest on that for the second year. That brings the obligation to 188,669 at the end of the second year. We then have an opening balance of that 188 at the beginning of the third year. We're going to charge another 6% interest, which is 11,331. And then to clear the obligation, we're going to pay the 200,000 at the end of the third year. But it's this notional interest charge each year that we need to reflect in the profit and loss account. And in the profit and loss account, that notional charge will be included as a finance charge. So whenever you use present values, because the time value of money is material, in future periods you're going to have the knock-on effect in your profit and loss account as a result of the unwinding of the discount rate. Okay, so if we continue on, we've identified how you determine the fair value of the consideration, which is the cost of the business combination. What you then need to identify is the fair value of the net assets that existed on the day that you acquired control. And the fair value of the net assets will include a fair value of any contingent liabilities that might have existed. But I need to concentrate for a moment on intangible assets. There will be many intangible assets that an acquired business might possess that are not shown in their individual statement of financial position. What we're told in Section 18, in Section 18 we're told that when there is a business combination, intangible assets that meet 3 conditions have to be recognised as part of the fair value exercise. The 3 conditions are: number 1, there must be a probable inflow of economic benefit and we can measure the value of the asset reliably. Number 2, the asset must arise from contractual or legal rights. And number 3, the asset must be separable, which means that we could sell it separate to the other assets in the business, or we could license it, or we could franchise it out to somebody. If you meet all 3 conditions, any intangible asset that exists must be shown as part of the fair value of the net asset exercise. If, however, we don't meet all 3 conditions, let's imagine for a moment we've got a brand. Let's imagine you acquire a business that has a brand. The brand will generate future economic benefits, and you may be able to place a value on that brand by bringing in a brand valuation expert. The brand arises from legal rights. Legally, we're entitled to the brand because we're buying the business. We'd be able to sue anybody who might decide to copy our trademark or to copy our brand image. However, the brand isn't separable. You can't separate the brand from the other assets because nobody would buy the brand on a standalone basis without acquiring all of the other facets of the business. So what we're told in Section 18.8 is that when you acquire a business, the intangible assets that exist that meet all three conditions that are up on the screen there, those intangible assets have to be included in the goodwill calculation. For other intangible assets that meet two of those three conditions, and the two conditions must be condition number 1 and either condition number 2 or 3. If you meet condition 1 and either 2 or 3, well then if you choose to, you can recognize the intangible asset in the goodwill calculation. In other words, you can include that intangible asset, and the example I gave a moment ago was a brand. You could include the brand in the fair value exercise, and that would cause the value of the goodwill to be reduced, but you don't have to. If, however, you choose to value that brand, and if you choose to recognize it in the fair value exercise, well then you have to do so for all business combinations. And you would have to recognize all brands. You couldn't choose just one brand. You'd have to recognize all of the brands that existed for that business, and you'd have to do so for each business combination. Now, practically, therefore, you can imagine that the majority of businesses will decide, I would assume, that they're not going to recognize those other intangible assets that only meet condition number 1 and either condition 2 or 3. But it is a choice that's open to you. The next thing that's a little bit unusual when you're looking at the fair value of the net asset exercise is that you have to incorporate the value for contingent liabilities. Now, normally we can't recognize a contingent liability on a balance sheet. A contingent liability is a possible liability, the occurrence or non-occurrence of which is dependent upon uncertain future events. And usually when you have a contingent liability, you don't show it on your balance sheet, as I said, but you have to disclose it by way of a note unless the possibility of it happening is remote. If, however, you acquire control of a business and that business has a contingent liability on the day that you acquire control, assuming that you can determine reliably the fair value of that contingent liability, you need to include it in the fair value of the net asset exercise. In other words, the fair value of the contingent liability will be included in the goodwill calculation, and that means that your goodwill figure will be higher to reflect that contingent liability. Now let's for a moment have a look at other liabilities. If you acquire a business, you might want to merge that business in with your existing activities. And that might involve you restructuring the acquired business, and that in turn might involve you having to make people redundant. If you have an intention to reorganize a business, and it's going to incur liabilities for you, you can't include those liabilities in the fair value of the net asset exercise. That's because those liabilities are arising as a result of your intention with the business. They're not liabilities of the business on the day that you took control. If, however, the business that you're acquiring control of had already initiated a reorganization plan, and if they had already notified staff members that they were going to be making them redundant, and therefore they already had the obligation to proceed with those redundancies, well then that would be a liability of the business that you're acquiring, and therefore it would be included in the fair value of the net asset exercise. But you can't make a provision for future intentions on the day that you acquire control. Nor can you recognize a liability for future losses that you anticipate the business will incur. Nor can you recognize a liability for future costs that you feel you will incur as a result of the business combination. It's only the liabilities that existed and the contingent liabilities that existed for the entity on the day that you took control that you're entitled to measure and incorporate into your goodwill calculation. The next practical issue then relates to provisional values. We're looking at having to put a fair value on assets, liabilities and contingent liabilities on the day that we acquire control of a business. And that might be a pretty big process because there might be a lot of assets and there might be a lot of liabilities. We're effectively given a 12-month period within which we can use provisional values for the purpose of calculating goodwill. So we can make a best estimate as to what the fair value of the assets and the liabilities are, and we can amend those provisional values as long as new information becomes available about what the conditions that existed at the date of the business combination reflected within 12 months. So that's a bit of a mouthful. Basically what I'm saying is you can use provisional values on the date of the business combination. The provisional values will be the best estimates of what you expect the actual values of the assets and liabilities are. And if you get more up-to-date information about the conditions that existed at the date of the business combination in future, as long as you get the updated information within 12 months, you can amend your goodwill figure. And you amend your goodwill calculated and you amend your goodwill figure retrospectively. So you'll adjust last year's balance sheet to reflect what the goodwill should have been had we access to the information last year. If it's more than 12 months between the date of the business combination and the date that the updated information becomes available, well then effectively you're dealing with the correction of an error. And if it's a material error, you're going to have to deal with the correction of the material error by using effectively a prior year adjustment. So you've got a 12-month period to get it right. If you don't get it right within the 12-month period, any adjustments required thereafter will effectively be dealt with by the correction of any errors. Then you've got your goodwill. Goodwill is simply the difference between the cost of the business combination and the value of the net assets effectively that you've acquired. Goodwill is an asset if it's positive. It's recognised on your statement of financial position or your balance sheet as an asset. It's amortised over its useful life. The useful life can't exceed 10 years. And if it's necessary, you'll have to carry out an impairment test on the asset in accordance with the principles in section 27. An example on that, if you have a look at the screen here, okay, we're told that H acquired 3/4 of S on the 31st of March 2018, and the first thing to recognise there is that we've acquired more than half of the share capital in a company, and on that basis we can assume, unless we were told otherwise, we can assume that we're able to control that entity. Because based on what we looked at earlier, if you own more than half of the share capital in an entity, well then effectively you've got the power to govern the financial and operating policies of that entity. We paid cash at 275,000, we incurred costs of 12. So relatively straightforward. We have a total cost of the business combination 287,000. The carrying value of the equity of the acquired business was 291,400. Now, the first thing to note here is this is the carrying value. We're not really interested in the carrying value, we're interested in the fair value, but what we'll do is we'll take the carrying value and we'll amend it for any fair value adjustments that are required. Remember, equity equals net assets. We're told the land assets of the acquired business have a fair value which is 19,000 above the net book value, and they also have a customer list, which is an intangible asset, that has been assessed to have a value of 12. And effectively we're asked to calculate the goodwill. Now, I just want to discuss the fair value adjustments here. The land assets have to be recognised because they're assets that exist for this business on the day that we've acquired control. We need to determine the fair value of the land asset, and we can see that it's 19,000 above its carrying value, so that 19,000 has to be taken into consideration. But have a look at the customer list. The customer list is an intangible asset, but that customer list would not be separable from the rest of the business assets, and therefore we have a choice. In accordance with section 18.8 of FRS 102, you can either include the customer list as an asset on the date of the business combination, or if you choose to, you don't have to incorporate it, and the resulting impact on goodwill would be that the goodwill figure will be higher. I'm going to assume that they've not elected to incorporate the customer list. And if we have a look at the resultant impact on the goodwill, the cost of the business combination is the cash that we paid at 275, the costs that we incurred on top of that at 12,000, that gives you 287,000. We then need to determine the fair value of the net assets acquired. It's a little calculation we need to do here. We know the book value of the equity. The book value of the equity is 291,400. There's an adjustment required to that to reflect the fair value of the land, which is 19,000. I've elected not to incorporate the customer list. The fair value of the net assets therefore is 310,400, and I've acquired 75% of them, which means I've acquired net assets that have a fair value of 232,800, but I paid 287.5. The difference is your goodwill. So your goodwill figure is going to be 54,200. It's positive, it's an asset, it gets recorded on your balance sheet, you'll amortize it over its expected useful life. That useful life can't exceed 10 years, and if required under section 27, we'll need to carry out an impairment test. So that's effectively how we calculate goodwill. Okay, the next issue that can arise is you might have negative goodwill. And another name for negative goodwill is a bargain purchase. A bargain purchase effectively is where you acquire a value of net assets, but the price that you pay is below the value of the net assets acquired. Now, it's very unusual that you'll get a bargain purchase. And therefore, if you do end up with a negative goodwill figure, the first thing that we're advised to do is to check our calculations. But if we're confident that the negative goodwill has been calculated properly, well then the negative goodwill will be recorded on the balance sheet underneath any positive goodwill as a negative asset. And we will release the negative goodwill into the profit and loss over the expected life of the related non-monetary assets that have been acquired. Now, there is a small caveat on that. If the value of the non-monetary assets in fair value terms is less than the value of the negative goodwill that you've determined, the difference is going to be released into the income statement or the profit and loss whenever you feel we will get benefit from it. Now, it would be highly unusual that the negative goodwill would be greater in value to the amount that we're going to recognise for the fair value of the non-current assets. But if you look on the next page, again, there's a little example here that will allow us to be able to go through the calculations that are required. Okay. Okay, so we're told that the cost of the business combination is 140,000. The fair value of the net assets acquired is 170,000. The fair value of the non-monetary assets in the acquired entity is 135,000, and they all have a remaining useful life of 10 years. And then the requirement is to calculate the negative goodwill and to show how it's treated in future years. Okay, quite straightforward. The goodwill calculation is you take what did you pay, the cost of the business combination, compare it to the value that you've acquired. We're told in the example what we acquired was 170,000. That means that we have negative goodwill. Negative goodwill will be recognised, assuming that we've checked our calculations and we're satisfied that they're accurate. The negative goodwill will be recognised as a negative asset right underneath any positive goodwill on the statement of financial position. Okay, the non-monetary assets acquired in the business combination are 135,000. This figure is greater than the negative goodwill, which is only 30. And because the value of the non-monetary assets is greater than the negative goodwill, we're going to write off the negative goodwill over whatever the remaining life of those non-monetary assets are. And just for simplicity in the example, we've said that the assumed life of the non-monetary assets are 10 years. If the non-monetary assets get written off over 10 years, well then the negative goodwill, I should say, gets written off over 10 years as well. So what we'd end up reflecting in the profit and loss is a 3,000 credit or a 3,000 gain each year to write down or to amortize the negative goodwill over the life of those non-monetary assets. Okay, the final thing I want to have a quick look at here is the consolidation procedures that are required when you have a subsidiary, the calculation of a goodwill figure for a subsidiary. Primarily what I want to get to then is the calculation of non-controlling interest, because I mentioned it earlier in the presentation. I said that when you take control of a business, you need to determine the acquirer, you need to determine the date of the acquisition, you need to determine the fair value of the assets acquired, the liabilities including contingent liabilities assumed. You also need to be able to measure the non-controlling interest, and you need to record your goodwill. And I've not dealt with non-controlling interest since, so I want to go through a pretty straightforward example as to how non-controlling interest is calculated, and I'm going to do it by use of the example that we have on the next page. But before I get there, we're looking at an example here where we have consolidation procedures. There's a couple of kind of standard issues you need to be aware of. When you're preparing a set of consolidated accounts, all group companies have to have the same year end. It wouldn't make sense to be adding companies' accounts together into one set of reported results if we're not looking at the same year end for each of the individual group companies. There is a bit of a leeway given. We're told that if the difference between the parent's year end and the year end of the subsidiary is no more than 3 months, where the subsidiary's year end is before the parent's year end. So, again, that's a bit of a mouthful. What I'm basically saying is, if the year end for the subsidiary is before the year end for the parent, and if it's no more than 3 months before the year end for the parent, well then you can consolidate the subsidiary's results in with the group by making any adjustments for any material transactions that happened in the intervening period. The second issue with regards to preparing consolidated accounts is that we have to have the same accounting policies for all group companies. And if you have an individual subsidiary that has a different accounting policy to the parent company, then you're going to have to make consolidation adjustments. You're going to have to amend the financial statements for that subsidiary to reflect what they would have looked like if that subsidiary had adopted the same accounting policies as the parent. The next issue that arises in preparing a set of group accounts is that you've got to cancel intercompany transactions. We're looking upon the group as if it was a single entity, and an entity can't trade with itself. So intercompany transactions are eliminated, intercompany balances are eliminated, and unrealized profits have to be eliminated as well. So the effect of any transactions between individual group companies effectively have to be removed from the group financial statements. But to show you an example of this, I'm going to move on to the next page. Okay, here we've got an example called Parentis. We're told Parentis is a listed company. It acquired 600 million equity shares in Offspring on the 1st of April 2016. The purchase consideration was 405 million. That's the price that was paid. Now, if you have a look at the statement of financial position for Parentis, that's the value that they're showing for their investments, which is 405 million. We're then told the SOFPs of the two companies at the end of March 2017 are shown below. And the company that they acquired the shareholding in is a company called Offspring. So if we go down here, the first thing I want to bring your attention to is the equity shares. And if you have a look at the equity shares for each of the entities, you can see that the equity shares are made up of 25-cent shares. So for Offspring, they've got an equity value of 200 million euros, but each euro has 4 shares, which means that they in total have 800 million shares. And that becomes important in a moment. Okay. If we read underneath that, we're told that at the date of acquisition, the fair value of Offspring's net assets were approximately equal to their carrying amounts with the exception of properties. These properties had a fair value of 40 million in excess of their carrying amounts, which would create additional depreciation of 2 million in the post-acquisition period to the end of March 17. The fair values have not been reflected in Offspring's SOFP. Offspring, we're told, sold Parentis goods for 15 million in the post-acquisition period. 5 million of these goods are included in the inventory of Parentis at the end of March 2017. The profit made by Offspring on these sales was 6 million. Next, we're told that Offspring's accounts payable account in the records of Parentis of 7 million doesn't agree with the Parentis accounts receivable account in the records of Offspring due to cash in transit of 4 million paid by Parentis. And basically there we need to cancel the account receivable, cancel the account payable, and recognise the cash that's in transit in our group bank account. We're told there hasn't been an impairment of goodwill. So I just want to go through and show you the calculations, the main calculations that would be required here. Okay, the first thing that I want to point out is we acquired 600 million of their 800 million shares, which is 75%. And when you have more than half of the share capital, you can assume, unless you're told otherwise, that you've got control of the entity. The entity is carrying on a business, and therefore we've got control of the business. And when an acquirer takes control of a business, we're looking at the necessity to have to calculate goodwill. The cost of the business combination is relatively straightforward. It's 405 million. If there were direct costs incurred, we'd need to incorporate the value of the direct costs incurred, but we're not given any information on that. We then need to compare the cost of the business combination to the fair value of the net assets acquired. And similar to the way I did the last example, I'm going to start off with the book value of the net assets. The book value of any business is equal to the value of its equity. And we know from looking at the statement of financial position that the ordinary share capital, which is part of equity, for Offspring is 200 million. And we're told what the reserves were on the day that we acquired control. Okay, so that's important. The day you acquire control is the day that you need to calculate goodwill. The day you acquire control, therefore, is the day that you need to determine the fair value of the net assets. We're given a statement of financial position at the end of March 2017. We don't take the equity value at the end of March 2017. We take the equity value on the day that we acquired control, which was the 1st of April 16. And we're given what the reserves were on the 1st of April 16, and we're given what the ordinary share capital was on that date. That's given up here. 1st of April 16. Okay, the book value, however, doesn't incorporate the fair value adjustment, and there is a fair value adjustment required of 40 million. So the total fair value of the net assets at the date of us acquiring control is 360 million. We're acquiring 3/4 of the business, which means we're acquiring 3/4 of those net assets. And therefore your goodwill is positive, it's 135 million. It'll be recognised as an asset on your SOFP, it'll be amortised over its expected useful life. The useful life can't exceed 10 years, and you'll need to carry out an impairment test if required to do so under section 27. Okay, so a relatively straightforward goodwill calculation. The next thing that I want to deal with is the unrealized profits. We're told that one of the companies, which is the offspring company, sold goods to their parent. The amount of profit that they made on the sale was 6 million. Now, what you need to remember is that you don't eliminate all of the profit, you only eliminate the unrealized profit. The value of the goods that they sold were 15 million, but there's only 5 million of those goods left at the end of the year on the group SOFP. So there's only 1/3 of the goods left, and if there's only 1/3 of the goods left, well then there's only 1/3 of the profit left. It's important that you identify who made the sale, because it's that company's retained earnings that you need to reduce. If you're eliminating the profit, you eliminate the profit from the company that made the sale. You also need to reduce the value of the inventory asset, because your inventory asset at the moment includes the unrealized profit. We've determined how much the unrealized profit is. We're going to reduce the asset by the value of the URP. The next adjustment that's necessary, again in the accounts of offspring, is to recognize the fact that the depreciation needs to be increased. We increased the value of their property. If you increase the value of property, and property being a depreciable asset, well then you need to increase, I should say, the depreciation. And we're told in the question that the effect on depreciation would be to increase it by 2 million a year. And there's been 1 year since we acquired control. So we'd increase their depreciation, it'll reduce the profits of offspring, and it'll reduce the property asset in the group. Now, I needed to do the two calculations for the unrealized profit and for the depreciation in order to be able to calculate the NCI. And there are two ways that the NCI can be calculated. I'll show you both methods. Each will give you the same outcome. It's up to yourself as to what you're most comfortable with. But one way to calculate the value of the NCI is to reflect that they own 25% of the business. When we acquired the business, the fair value of the business's net assets was 360 million. Now, you took 75% of that and you brought it into your goodwill calculation. The NCI owned the other 25%. So on the acquisition date, the NCI acquired effectively a value of 90 million in that business. Since then, the business has made profits. And if the business makes profits, you'll be entitled to 3/4 and the NCI will be entitled to the other quarter. If you have a look at the SOFP, you can see that the profits for the year since we acquired control are 20 million. But that figure isn't accurate, it's not correct. That doesn't include the elimination of the unrealized profit. We need to reduce the subsidiaries' reserves by that 2 million. The sale of those goods that resulted in the unrealized profit happened in the post-acquisition period, and therefore we need to reduce the post-acquisition profits by that 2 million. We also need to reduce their profits by the 2 million extra depreciation that's necessary. So they reckon they've got profits of 20 million, but we know that they're really only, from a consolidation or from a group perspective, they've really only got profits of 16 million. And we're going to give the NCI a 25% share of those profits, which is 4. So when you took control of the entity, the NCI was worth 90. Since you took control of the entity, the NCI are entitled to an extra 4. And that results in the NCI figure of 94 million. Now, that's one way to treat it. The other way to calculate your NCI, which is a bit more straightforward, I think, is to have a look at the statement of financial position or the balance sheet of the subsidiary. And if you have a look at the balance sheet in the example for the subsidiary, you'll see that their net assets or their equity is worth 340 million. Now, as an individual entity, that's the correct value for the net assets in that entity. But at the group level, we need to incorporate, or we need to reflect, the fair value adjustment for the property. So we need to adjust upwards the value of the property assets by 40 million. We then need to reduce the property asset by the 2 million depreciation. And we have to reduce the value of inventory by 2 million. So the adjusted net asset value at the group level for offspring is 376 million, of which the NCI owns 25%. 25% at 376 million gives us our 94 million. That will be reflected for the NCI value. That NCI will appear on your group SOFP as a part of equity, but shown separately from the equity of the group. That basically brings to a conclusion the presentation on section 19 on business combinations. If you have any questions or queries on any of the elements that were included, don't hesitate to contact me at liam.doran@accountancyschool.ie. I'd be quite happy to deal with any queries that you might have. Thanks very much.